All right, everybody, welcome back to another edition of Market Talks with DrStoxx. It is the 10th of December, 2024. It is a Tuesday. Tomorrow we get the CPI coming out, the all important read on inflation. Market economists, investment houses, they're expecting just a little bit of a tick higher in inflation. And that's, I think, what we're probably going to get because we've seen some really strong consumer sentiment numbers. We had huge influx of purchases during the good Black Friday, Black Friday, Cyber Monday, the whole business there, that whole weekend. Lots of shopping being done, and we're moving off, of course, into the Christmas season. So I do think that the latter part of November was a strong time for prices moving higher. And we've also saw a big rebound in the labor market. So that tends to put a little pressure on pricing as well. So I do think we're going to get a tick higher, and the market may take that in stride. But I'm going to show you some things here that lead me to believe that the next week, maybe 2 weeks, I don't think we're going to get that long-winded, but maybe into the FOMC meeting next week, things look like they're going to be a little bit on the softer side. We're already seeing that. We had a down day yesterday for most sectors and most stocks. We've got the repeat of that today, although it's not as strong. We're still pretty close to where we closed yesterday, but we are seeing most sectors red, most stocks red, and even some of the mags, the Magnificent Seven, not doing all that well today. So that suggests that we've got a little bit of weakness ahead. We have to be careful. We got stopped out of a few trades this yesterday, a couple this morning as well. Some for profit, some for loss, and that's just how it goes as we transition. Right, we've had this nice, easy bull market, bullish, 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 easy to buy longs. You ride them up, and then you move up your stops, and then you take your profits when you can. But when we get that transition to the downside, it can happen very quickly. It's been 48 hours now of a fairly weak market, and it hasn't really even been that weak. And so that's the tough time to trade. It's a much easier transition when the market's been going down, 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 and then it gets ready to bounce back, than to time the top of these near-term moves, these little pullbacks. But that's what we're doing, right? We are already shifting from more of a easy bullish market to something a little more challenging. All right, so let me go ahead and talk a little bit about some charts. But if you are joining me for the first time, this is coming to you from the live trading room of the DrStoxx.com website. If you go to DrStoxx.com and click on the live trading button, you're able to join us here in the room. You'll get all the trades that I take throughout the trading day. It's a great community of dozens and dozens of traders for all different levels. We all support each other. We encourage each other. There's a lot of training that takes place. There are a lot of great calls that take place. And it's just a great place to hang out during the trading day. If you can't do that, if you can't hang out throughout the day, then click on the subscribe button and you'll have access to one of my trading advisory market letters. They get sent out early in the morning for the next day's market. All right. Let's go to some charts, and let me show you one thing that is important to do. I like to keep a watch list of what I call market leaders. This is a little different than a list of strong stocks. So I use my IBD Market Surge screening software to find the best companies trading in the market right now. These are the strongest companies in terms of growth, sales, profit margin, accelerating earnings, forward guidance revisions to the upside, analyst support, and all the rest. Those are the best companies in the market, and those are the typically the ones that get that do okay, regardless of what the market is doing. And they're always good stocks to keep a list of. But when I talk about market leaders, I'm talking about the stocks that have had the best performance over the last year, right? If you look at the stocks over the last 12 months and you weed out the little tiny penny stocks and you weed out those that are trading under 500,000 shares a day, you weed out the little micro caps, and you've got a list of the stocks that are up 100%, 300%, 500% or more over the last 12 months. Those are the market leaders. Those are the stocks that will start to give early warning signals when the market is a little too extended, right? These are risk on stocks for the most part. Now, some of them are quality names, like NVIDIA is on this list, but some of them are like meme stocks. They don't have any real earnings. They're spec names. They're all about growth and not about, what have you done for me lately? Future growth, I should say. And when these stocks start having some trouble, we know that we're probably near a near term top at the very least. Let me just say that this list I've got on here, you're going to recognize some of these: MicroStrategy, the Kava Group, the restaurant holding, AppLovin software name, PLTR, right? AI name. Coin is on here. Lemonade is on here. NVIDIA, I mentioned Netflix, Fortinet, Facebook, Tesla, all the rest, Carvana. When these guys start having trouble, we know that big market makers, people that really like to chase alpha, that really like to take on risk, they're starting to pull back on these. Now, let me show you just a few. We'll sort these by worst to best, right? So AAOI. Here are some of the things you want to look for, right? Are these stocks as a set having some trouble? There are several things you want to look for. One is the gap and crap. Another is a big slam, right? A big red stick on heavy volume. And a third is a gap down. If you see any of those three, and the fourth is a lower high. When you see any of those four things, right? The big slam, the gap down, the gap and crap, and the lower high, when you see those things showing up in a whole bunch of these stocks, you need to be a little cautious, right? You need to be careful. So here's AAOI, some kind of electronics firm. I know the ticker symbol. I don't know the company. Big red stick, heavy volume. We might call this a lower high. We've got the gap down. Everything here doesn't look very good. AAOI, I wouldn't necessarily call it a short candidate, but I wouldn't kick anybody in the pants for shorting this stock because it's probably going to head back down to the mid-20s. Lemonade, big slam, or that's even a gap and crap, lower high, right? Couple of slams. Big slam was on good volume. Also, I'm sorry, I should have mentioned this. There's a fifth thing you want to look for, and that is the false breakout or the bull trap. Something like this ticker symbol right here. See, it got all the way up to like 53, couldn't break out, couldn't hold those highs, couldn't close at new 52-week highs or all-time highs. I'm not sure which is this. And then comes right back down and then is weak for a couple of days. That's a false breakout or a failed breakout or a bull trap. All right, so here we've got a long list. Bull trap, gap and crap, big slam on heavy volume, lower high, and gap down. So we've got several of these right here. VST, one of the best. I think this is the. I always get VST and VRT mixed up, but I think this is the utility firm. So here's your gap and crap. Here's a big slam. We don't really have any gap down. We do have a lower high. So we're starting to see a pattern here. Here's a big gap and crap on heavy volume, couple of slam days. Don't really see the false breakout or a gap down, but there are a couple of bad things there. So app had the gap down. This was all over the trading boards the other day. Gap and go to the downside. That is always, always, always a trend killer. Doesn't mean that the trend is over. Doesn't mean it's not going to go back up to 52-week highs. But for the next few days, maybe a couple of weeks, this is a no-go zone or a short. I have to say it, but this is one of the strongest stocks in the market. Huge percentage up over the last 12 months, and the party is pretty much over for at least a while. So gap down on a 52-week high, especially like this one on heavy volume. That's not in and of itself a sell signal, but when the low of that gap down day gets exceeded, which it did today, and it's below that low right now, that's the signal. That's the sell signal. So you can see with all these strong names, these market leaders, were starting to see some trouble show up. Kava. I really did think that 130 was going to hold today, and it did for a little while. It hit 130 and it bounced back up for a bit, but it's right back down through 130. Now, I do think Kava will have its moment. Why? Because it's only at 300 restaurants. Their plan is for 1,000 restaurants before they start to consolidate. And on those numbers, it had this huge gap up on earnings. It couldn't hold that. So that's also a sign, right? It's a big gap and crap on heavy volume. But just the fact that the market thought, at least for a while, it was a $170 stock suggests that it will get back up there at some point, probably sometime next year. So all kinds of bad things here. Gap and crap, big slam, false breakout, lower high, big slam, big slam. Yeah, Kava's not in a very good place right now. Here's an energy play that is actually, here's the high. There's a gap and crap, lower high, gap down. Yeah, all kinds of bad stuff going on here. NVIDIA, let me get rid of some of these things. There's not really a whole lot on this chart that is horrible just yet. We do have a little gap there that was near all-time highs. We had a gap yesterday that went down to the 50 and looked like it was going to hold right there, and then it's right back down again today. We had the false breakout on that day. That's a bad day right there, right? It went all the way up, drew in all these new longs. Maybe some of us in the room bought shares of NVIDIA on that breakout day, and then it went right back down very shortly thereafter, and then two big, 3 or 4 actually sell-off days, bringing it all the way down from near the blue zone down to the pink zone in about 4 days. That's ugly, ugly price movement on heavy volume. That's not good, right? That is not good. So clearly, the market is sending us a signal here that the risk on trade is no good right now. These market leaders who are up 4, 5, 600% over the last 12 months are due a big haircut, a big haircut. And the guys that move the market, the guys with the deep pockets and the big funds, are pulling their cash out of these things, pulling the cash out. So don't think about buying the dip in these. You'll get in trouble if you do. But recognize what's happening in this set and realize that they are out of favor right now. They are out of favor. And if we were to go down the list, we'd see a lot of the same stuff, those 5 signals, right? The gap and crap, the lower high, the false breakout or bull trap, the gap down, and the big slam. We'll see that on this whole list. So that's one thing, right? When you start to see that in the market leaders, and I didn't select these at all. Here's what I did to find these. If I can find my market surge. So there's a couple of things you can do. One is I went over to FinViz and I just built a little simple screen that was a minimum price of $20, minimum average volume of 500,000, and then I took those in a market cap over 2 billion. Those are the 3 parameters. And then I sorted those by performance over the last 12 months and took the ones at the top. And then I did something very similar here with market surge, although I did it a little differently. So I have a simple price of $20 per share minimum, 500 shares per day minimum, accumulation rating of A, that means it's been really strongly under accumulation, and a relative strength rating of 99. So that right there, that's going to give you the stocks that have the strongest price performance over the last 12 months. And here you've got App, Carvana. You've got a few others that didn't show up in the other one. You've got Reddit in here. You've got Root, right? So I took some from FinViz. I took some from Market Surge. I threw them into this list, and you can see some problems. Now, something like Tesla, which is very good, has not shown much in the way of those kinds of negative signals, not at all. So we did have a false breakout a few weeks ago. turned out to be a buy the dip moment with a gap up, sideways consolidation, a nice run today. Yesterday looked a little bit, kind of trappy, but there's no follow through today. We're right back up to what I think are new 52-week highs. And there is right around 400. There was a very strong volume shelf there, and we're above that. So Tesla is one of the rare exceptions on this list that's actually doing really well and not showing us that people are getting out of it. In fact, people are still accumulating. All right, so that's one of the things you can do. Keep track of market leaders when you start to see those kinds of signs. Any set of those 5 indicators I just mentioned, you have to start to be cautious. Now, the other thing you can do is you can go over to stockcharts.com, one of my old charting services. I used to use this all the time. In fact, I was a representative for them for a while, and all my trading books use charts from stockcharts.com. So I've been very familiar with it, and it's a great site, and they have a lot of good free research on here. And one of the things you want to check every now and then, maybe a couple of times a month, you want to go over to their market summary page and scroll down to where is it? Right here, market breadth. Scroll down. Here are several things that you want to keep track of. You want to keep track, obviously, the VIX, right? The fear indicator. When it's up above 15, we're starting to get a little bit worried. When it's up above 20, we should be really worried about downside in the market. We're still below 15. We're at 14 something right now. So we're still in a pretty complacent, fairly easy bullish market. So I don't think we're going to get much in the way of an extended pullback, but a week maybe of some sideways churn with a slightly bearish bias. And some of those names I just mentioned are probably going to get hit pretty hard. That's probably where we're going. The put call ratio, you want to make sure that you're not seeing extreme prints to the low side. If you see low numbers like below 0.7 or near 0.7, here's one below, but here's several that got down to like 0.72. You're starting to see very, very little fear in the market and a lot of greed. Nobody's buying puts, right? Everybody's buying calls. That's what that number means. 0.7 means everybody's buying calls and very few puts. So that's when the market can get a little bit scary to the downside because nobody's ready for it. And the same is true when it goes way up. Anything above like 1.2 is a very fearful market, and that typically marks a bottom. You want to check the summation indexes. So if the market is hitting new 52-week highs, you want to see the summation index up near 52-week highs. The fact here that the New York Stock Exchange, the big board stocks, are not seeing a summation anywhere near the early October high suggests that money's flowing out. Right? Money is flowing out of the big board stocks. You're going to see something similar with the NASDAQ, right? We are below the highs. Now we're stronger here than the other ones, than the big board, but still below the highs, even though price was up at 52-week highs just a couple of days ago. And then the last thing I like to check are the oscillators, the McClellan oscillators. The McClellans measure volume price inflow versus volume price outflow. And so when the oscillator is moving higher, we're seeing more money flowing into the market. The oscillator is moving lower, we're seeing more money flow out. And it's going to shift up and down almost on a day-to-day basis. But what we're looking here for are the extremes. So when you get down to like a negative 50, negative 60, extreme fear, expect a bounce. When you get up here to 50, 60, 70 to the top side, too much complacency, expect a fall. So expect a pullback. At least expect some consolidation. The last thing I like to check, among some other things, I mean, this isn't the only thing we're doing. Of course, you always want to take a look at the index charts themselves, so we have a good sense of what the price is doing. But if you go to the bullish percent indexes, you want to look for 80 and 20. If you see a number at 80, then that particular index or that sector is way, way, way too strong, ready for a pullback. 20, way, way, way too weak, ready for a bounce. We don't see much here that is either above 80 or below 20, but we do have too much enthusiasm for communication services. This is Google mostly, and for the banks. So it doesn't necessarily mean the banks are going to crash like crazy, but it does mean that too many banks are showing too much enthusiasm and price, and they're due a pullback. So those are some things. Again, as a general rule, much easier, much more accurate to take all that information I just told you and find a market bottom with that than it is to find a market top. But I do think, given what I just showed you, um, I don't think we're at a market top in the strong sense, but I think for very near term, and I've been saying this since mid-November, that December is probably going to be weak heading into FOMC. FOMC, we get the 25 basis point cut, we get some dovish speak from Powell, and at that point, we should have our nice Santa rally. I don't think we're going to get the Santa rally until we get past Powell. We also have to get past CPI, and that's tomorrow, and then PPI on Thursday. Okay, let's look at some charts. All right, so let's look at indexes first. Let's do this with SPY, and let's do this with my divergence indicator on here. So this little arrow, I don't know why it keeps shifting around, but every time the market has hit new 52-week highs with some bearish divergence, however slight, right? This is slight, only one indicator showing bearish divergence. This is heavy, 6 indicators showing bearish divergence. Right now, we're somewhere in the middle with 2. But every time for the last 6 or 7, here's another one, 6 or 7 instances, we've had the market pull back, sometimes only for a couple of days before it goes higher again and hits a new high, sometimes for 2, 3, 4 weeks. When the market pulls back, it can usually pull back to the nearest major moving average. The 21 period moving average would be the one that we're looking at most prominently today. We got a hit of that with the small caps today, but we're still above that with the S&P. We're still above that with the QQQ quite a bit. But you can see every time we get these divergence indicators, it does get weak for at least a little while. These divergence indicators are very, very short term, and there are some, especially in individual stocks, where they just don't work at all. You get the divergence indicator on day 1, and on day 2, it's right back up again to 52-week highs, and it never turns around. So on indexes, however, they do tend to work more reliably. And as you can see, right, big slam, little slam, fairly mid-sized slam. So somewhere, I think we're going to get a little slam down to the 21, maybe the 50, the midline of the LRC, but the 21 EMA, which would get us down to, by the time it met there, about 514. Current price is 520. So again, 1.2%, 1.3% from current price, not a big pullback. We can live with that, but that doesn't, you're going to get stopped out if you're going long Apple, Amazon, and well, there are some that are still doing okay, but not a good time right now to get on board the big stocks at the top of the list. Scroll down the NASDAQ 100 and find some of those names that are down near the 50 period moving average that have already done their pullback. They're the ones that are probably going to get some fresh inflows. So small caps, we went long small caps today, really doing nicely so far. So although my timing wasn't great, got in a little bit too late off that early run, and then it pulled back, and then it went right back up and hit new highs of the day. But this is a classic reversal bar. So nice soft pullback, right? Nice soft pullback, not even a 45-degree angle. That's what we like to see. And And then the test of the 21 period moving average this morning, reversal right back up again after flushing out all the weak hands, after flushing out the new longs, got all those guys, and probably flushing in or drawing in some guys who wanted to go short. And then, of course, they all had to cover and scramble, and we got a little squeeze. So this looks good as a reversal back to the upside. So with that in mind, right, people are going to be taking money out of the S&P, taking money out of the NASDAQ 100. Where's that money going to go? Into small caps. How about that? Into small caps. Small caps has been a lagging sector. We're still well below all-time highs. We did test recently, as you can see from the double top there, the new 52-week high. Result, pullback over about 2 weeks. That's a pretty lengthy pullback. And the reversal bar today. So we're going to see if we can ride this up a little bit higher. Not looking for anything too extreme, but a couple of days of some upside should be in the cards. I almost got us long gold. We should have got long in the pre-market because it's just been up and up and up ever since. But this is a good look. If we look at the futures contract, which gives us the overnight data, you're going to see I'll just put an arrow on there. I know it's red, but I'll just use it. We're going to see a nice set of higher lows out of the pink zone, a little bit of a sideways consolidation in that area right there. Here's your nice looking reversal bar that was Friday last week, follow through yesterday. Got up outside of that box, above the 50 period moving average, pulled right back down into the box, below the 50 period moving average, and then ticked a little bit higher into the close at 5 o'clock. Opened up at 6 o'clock, exactly where it was, and it's been uphill ever since. Now, we are up at some resistance, which is why I didn't get us into this trade. It was about 27.10, 27.12 when I was looking at getting us in, and 27.17 is pretty significant resistance. So I didn't want to get us on board a new long and then get stopped out on a reversal off that level. So we'll see where it goes, but this does look like it wants to get back up to 2,800. And what was the prediction for 2025 with gold? I think it was 3,000, and it was one of the big investment houses like JP Morgan or Goldman Sachs. One of those guys came out yesterday and said, we're bullish on gold through 2025. Going to see some weakness in the dollar. We've got all kinds of, we're going to have some shifting around of the American economy over the next year to 2 years if and when the the DOGE, the Department of Government Efficiency starts, if they don't have any power, right? So they can't legislate any of this, but they can make recommendations to Congress to start cutting out federal excess, shutting down, government agencies that aren't doing a whole lot of stuff, and reducing the size of government generally, reducing the spending of government generally. Now, that's overall long-term good for the economy, but short-term, that's a lot of pain. And if you're raising revenue through tariffs, you're also, that can be problematic too. So I think the American economy, with all of that happening, will be much better, but not without some pain initially. 2025 is when that all starts to unfold, and the market may be a little bit squirrely with that. It's going to take a quarter, maybe 2 quarters, for the market to kind of get a good sense of where this is all going. Once it has that good sense, and once it can see ahead to the next, the third and fourth quarters, then I think we'll see a really nice end to 2025. We should be higher at the end of 2025 than we are right now. Okay, so Bitcoin is a bit problematic, but I do think it is a good long-term hold. We added some Bitcoin in our wealth building portfolio today. It's just doing this extended flag pattern here, or consolidation. And the good note here is that the lows are getting higher. we're not seeing lower highs here. We're not seeing big slams, although yesterday might kind of qualify as that. We're not seeing gap downs, but we are seeing higher lows and we're seeing testing of the highs, right? Kind of pushing the high a little bit higher each time. That's bullish action. I don't see anything bearish here. We should be okay going forward into next year. Okay. That's really all I have for you. Just to recap, so we're looking at very near term. The rest of this week, likely, and CPI tomorrow is probably going to be a catalyst. Now, I could be totally wrong. I hope I am, but I do think we have to be careful. We have to, if we're going long new things, then we need to find really good setups in strong stocks that aren't going to be vulnerable up at 52-week highs, right? We want them to have some kind of a pullback already, like we saw with TNA. The other thing we can do, and I want to show you what I did with Upstart. I did this yesterday. So Upstart is one of those stocks that could be on the market leader, but just isn't quite as, on a performance basis, isn't quite in that same league. But big gap up on earnings, that's a good thing. A gap down a few days later, that's not such a good thing. A lower high, gap down, those are not good things. Big slam, lower high again. And yesterday was an attempt at a breakout that, today, attempt at a breakout that did not work. So these are bearish signs, short-term bearish signs. And my thought was that if we can sell some calls up on top, right? And I have to say that this is a strategy or an approach that is one of the favorites in my pro trader group. I don't do a whole lot of it. I do sometimes add short calls on top of a diagonal debit spread. So I've got the short put somewhere at the money. I've got the long put down below for protection. And then I short a call up on top, which adds to the profit potential and gives me some additional downside protection. So I've got the long put down below, I've got the short call up on top, and it's just a very high probability, although not always a real good return, but a high probability win. And you can do that week after week after week. So with Upstart, you can short something like the 82, even I would say the 81. What was the high today? The high today was 81. So you could short the 81 calls. You're probably going to get about $100 for each of those. So that means if you're put into a short position by Friday at 81, your actual cost basis is 82. So you're actually short the shares at 82. I don't think there's much chance that that would get exercised. I think you're much more likely taking that profit. And that's one way. It's a low risk way. It's a high probability way of profiting from a market pullback when you don't think it's going to go that far, right? We make money as long as it stays below 81. It's at 75 right now. So it can go up 6 points between now and Friday and you still take 100% profit. So that's the kind of thing you can do when you have a market like this one. It's not a bear market. We're not expecting a huge drop or pullback or crash or anything like that. How do we make money in a market like this? That's one of the ways, right? That's one of the ways. Another thing you can do, something like Kava would be a good example of this. Now, this is a little riskier. You have to really know what you're doing. But you look for stocks like this, good strong stocks, good companies, growing companies that have a big red stick. That big red stick pumps up the implied volatility of the puts. And then you can short some out of the money puts, maybe the 124, right? It's at 127.50 right now. And I suspect that's probably near or at the low of the week. If you short the 124, you might get a couple $100 for those from now to Friday. As long as it closes above 124, you're going to take all that money home. So that's another thing you can do. It is more of a bullish approach, but you're taking advantage of these big downdrafts, right? That those downdrafts pump up the implied volatility, and that makes your trade that much more not only profitable, but also gives you more probability that you're going to take full profits. Now, in the Here's your obligation. So if you do short the 81 put for Upstart and it closes at 81.01 on Friday, you're going to end up with a short position on Monday morning. What can you do? Well, you can do a couple of things. You can just cover them right away on Monday morning and wash your hands and take your little profit and move on. Or you can hold that short in the expectation that it will show some weakness along with the rest of the market for at least a few days and then cover it later at 78 or 79. Or alternatively, you've got short shares, you can, which is a bearish position, you can counter that with a short put out of the money down below, and that's a bullish position. So if it goes up, you're okay. If it goes down, you're okay. It's kind of like capping your risk. So several things you can do with options that will enable you to profit from market pullbacks when you don't think the market's going to go that far down. If we think it's just going to crash from here, then the best thing to do is short the S&P and short the Nasdaq. We are short the S&P in the live trading room. We've got on SPXS. You can also short the S&P, the Nasdaq 100 using the micro E-minis. I love to do that because it's a very low capital intensive position. You don't need a whole lot of money. You can day trade those to your heart's content, even if you have a small account. So I like to short the micro E-minis, or as we did in the live room, we went long the inverse 3x bearish ETF for the S&P. All right, guys. I will take I want to get back into the main room. It's now 3 o'clock, so we've got an hour of trading. I do want to take a few chart requests. Don't inundate me with too many. So let's see what we can do here. I just take about 4 or 5 of these. SMCI. Let's get a bigger picture of this one. So this was one of our favorite stocks to trade because, man, when it was up here in the, well, it's split, right? It split, what, 10 to 1, I think it was. When it was up at $400, $500, $600, $700 per share, it was a lot of fun to trade, especially if you had some way out of the money calls. You know, I think at one point it was down around 700-800. We went long the 1,000 calls, like 200-300 points above current price, and it was a beautiful trade. However, it's been all downhill ever since. And then in this area right in here, it had this accounting problem, turned out to be a non-event, but there's still hangover from that. I don't know exactly. I just have not traded SMCI since it's had those problems. And I don't frankly recommend anybody doing that. However, I do have to say that right now, if you're long, you don't want to be long. This is setting up for a short potential. You've got the gap and crap yesterday. You've got the follow through today. Volume is tapering off a little bit. That's a little bit of a bullish hope. But the gap and crap, the lower highs that we're seeing here on this downtrending slope, and everything is just kind of falling off a cliff and leaning toward the right, to the lower right. It's just not a good place to be. So it's a short. It's not a long. The only time I think I would be interested in it as a long would be a breakout above that level. So that's about 49. It's got to break above 49. It's got to hold that level for a week or two. Maybe it gets a little bit above and pulls back down and tests it again, something like that. And you're 2 or 3 months probably away from that kind of structure. Everything can change, of course, very dramatically overnight. With any stock, that's always true. But just looking at the current chart, that's probably the path of least resistance is to stay below that level for a while. And even if it does get above, it's not going to be a buy until it holds, tests, and shows me some bullish inflow. Not seeing any of that here. Let's see. Oh boy, Microsoft. Yeah, this is interesting. So Microsoft, the shareholders had a vote today. I didn't know it was happening during market hours. I'm surprised at that. But there was a vote today by shareholders on whether or not to start collecting Bitcoin as in the way that many other companies are doing these days, and it looks like it got voted down. Interesting. So that may not be initially real good for Bitcoin. Bitcoin, I think, was a little bit jumpy to the upside earlier today because of the hope that Microsoft would do that. But now we've got a whole different look for Microsoft, right? This gives me a good example here of a classic reversal bar, in this case to the downside. Up, 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 up. Then we get a open inside of the range of the previous day, a big move to the upside that takes out all kinds of at least 20 days of highs. We certainly did that. This is multi-month high. And then a move before the close back down inside the range of the previous day and below the open of that day. That's a classic reversal bar to the downside. It's a bearish reversal. Now, the only saving grace right now is that there's not a whole lot of volume going on, but on a price basis, this is a reversal, and it's up here in the blue zone, and it's not exactly the most robust uptrend. So where's it going to go? 21 period moving average is the first target. The midline of the LRC is the second. And if it gets all the way down to test the top side of that wedge, that big bullish wedge that we were looking at, and we were down in this area here thinking, maybe it's got a chance of breaking out. And then it did, and I didn't really trust it. And it was a semi strong, not really much of a follow through the next day. And then it just was off to the races from there. So not a good look today. It's bearish reversal. If you are long Microsoft, you take your profits and we'll wait for a pullback. I don't really think it's a short either, but if you wanted to short it, I wouldn't put anybody out of their misery for that. AMD is sub 130. Wow. Yeah, so AMD, Intel, these guys are in a world of pain right now, and there's really no near-term end in sight. So it is totally a no-go zone. Now, the problem is you can't really short this either because the vulnerability of a big bear market bounce, they can be very painful if you're short, is a possibility here. There's absolutely nothing bullish in this chart at all. This is just ugly everywhere. The only thing that is not ugly is the LRC, which is flat, right? It's a trading range. We're down at the bottom of the range. So that is potentially a place where it can hold and get a little bit of a bounce going. But, the problem is that people aren't buying PCs as much as they used to. And AMD is kind of a one-trick pony. They need to expand out into other things like NVIDIA has done. NVIDIA used to be what do you call it? A graphics card maker. That was it. That was their one big thing. And then they got into AI and data centers and all kinds of good stuff. So AMD hasn't been keeping track of that. Yeah. So AMD's had a no-go zone, ugly, 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 and I don't even think there's good value there as a longer-term investment. I just would wait until they turn that company around, and it may not turn around. It may be down there in the 20s with Intel soon enough. EPAM. Come on, EPAM. Okay, last one here. All right, so you see the difference here with this one. Let me just take a quick look because this reminds me of another ticker symbol, PRGS. Yeah, this is also good. I don't know if it's the same. They're both software companies, but both have really good charts. So this is the kind of chart when I'm talking about a strong stock, right? Not a market leader, but a strong stock. This is it, and PRGS is another good one. Up near 52-week highs, big gap up on earnings that never even got close to closing, coming back to test the top of the gap and then bouncing very quickly right off of that. That is all bullish action. The only little bearish thing I see is this big red stick down here of volume on that particular day, but that's not a bearish candlestick. It's just that the close is below the open, so you get a red stick down here in the volume. It was actually an up day on price. A lot of volume came into that because of the breakout, and then it reversed right back down. Now, if there was follow through yesterday, if there was follow through to the downside yesterday, you had a gap down, or you had a gap and crap, or you had a big slam, then I would say it's an avoid. But we didn't. We got a hold and a reversal back to the upside today. In fact, this looks really good. This is just very good. Now, is it a big exciting stock? Are you going to make a 100% return on this? No. But this is a very good, solid 4, 5, 6% upside swing trade. You can leverage that with some calls. And I would also recommend, which I like a little bit better, PRGS. I like it because it has done this nice little soft pullback to the 21, testing it, bouncing back up. Everything is rising very nicely. The stacked MAs, the uptrending LRC. And instead of being right up at 52-week highs, we still have a little bit of room before we get there, right? There's about $1.30 or so to get to 70, and then 70, we still have a lot of upside up to the blue zone, which is your ultimate target. So there's a little more of a potential return there. Instead of 4 or 5%, you're looking at 10, 11%. All right, guys, I'm going to let you go. God bless everybody. Have a great rest of the afternoon. I'll be back in the room in just a little bit. Bye for now.